organizing the energy finance session within the AFI conference. And it is a pleasure for me to introduce you with Professor Ronn who is chairing this session. So thanks for all those who are here present at ESSEC Business School, as well as those who are following us through our webcasting service. Please, Jérôme will introduce you with our speakers.
Okay, thank you very much. So we basically have two papers on the program. The first paper is Commodity Forward Curve Dynamics with Inventory Information. So the paper is by Marcel Prokopchuk and Sebastian Weisdom, and Sebastian is presenting.
So thank you, Jérôme, and warm welcome also from my side. So I'm Sebastian Weisdom from the University of Hannover, and I present today a paper, Commodity Forward Curve Dynamics with Inventory Information, which I have worked out together with my co-author, Marcel Prokopchuk. So what's the motivation behind our paper? So we follow, and this paper follows a bit the discussion about reduced form asset pricing in commodity markets. The starting point of our paper will be the famous Gibson and Schwartz model. Just so the people arrive. So basically, this paper is about the reduced form asset pricing in commodity markets. And the most popular model, of course, for all of us, is the Gibson and Schwartz model of 1990. And when I would explain this model to someone, it's like a two-factor model, and the dynamics of the commodity forward curve are described by the first factor, which is like the spot price dynamics, and then there's a second factor, which is the convenience yield. However, when I would now explain this model to an economist, economists often don't find it so appealing because you have the second state variable, which is the convenience yield, and economists don't feel so good about it because they cannot observe it in the real market, right? So we have economists, they think about GDP and about the figures which they really can handle, but a convenience yield is more like an abstract figure they cannot handle. So the idea of this paper is now, can we make like a step towards the economists and make it a bit different? And the idea what we have in this paper is to model instead of the convenience yield, let's model the inventory levels as second state variable, and let's see if we can also improve the model fit and the out of sample properties of this kind of model. So why can we do that? Why can we model instead of the convenience yield the inventory? So why is that idea reasonable? So first of all, we have the theory of storage in commodity markets, which is like a broad literature and which provides the first explanation about how commodities are linked to the convenience yield, more or less. So we know that the more the inventory levels decrease, the higher is the probability of a stock out, and hence a huge price increase. So the lower the levels of inventories, inventory sellers will demand more yield or more rate in order to sell you the commodity. And there are now recent papers of Gott and Hayashi and Rubenhorst in 2013, but also Simeonidis et al., who used real-world inventory data and did perform an empirical study. And they could show actually that the future basis can be significantly explained by by inventory levels. So this is the motivation why we say let's try to use this fact. So we have this empirical observation from the authors that the inventories are a significant explanatory for the future basis. So let's use this fact for asset pricing as well, and let's see if we actually can improve the out of sample properties of such a model. A side effect is, of course, by using inventories, it is also more appealing to economists and also for practitioners, of course, because if you ask a trader at an energy trading department, if he has a view on the convenience yield, he will tell you, yeah, I might have. But if you ask him if he has a view on how inventory levels will change over the next period of time, he might have a very sharp view, actually. So the contribution to literature of our paper is threefold. First, we will broaden the class of commodity term structure models which use inventory information as an additional source of pricing. Second, we will show that our model actually has superior out-of-sample performance compared to the classical Gibson and Schwartz model in terms of hedging abilities. And third, we will show that the parameter estimates also support the theory of storage, and those estimates will show a negative dependency between the inventory levels and the convenience yield. Everything. Okay. So some technicalities. So let's jump directly into our model. So we see our model in the risk neutral and in the real probability measure and in the risk neutral probability measure. We see in equation 1 we have the typical spot price dynamics, and then the convenience yield. We don't model the convenience yield now as a stochastic process, but use now here the structural dependency between convenience yield and inventories, and model now the inventories as a second state variable, and use therefore here an Ornstein-Uhlenbeck process, which is from our point of view quite suitable because it has this mean reverting properties. And with this is our new model, which we will then try to estimate and also look at the characteristics and of the probability. Important, of course, the alpha and beta, which are like define our structural relationship between the convenience yield and the inventory levels. So this is a bit more only for information. It's about the pricing equation we have derived for that kind of term structure model. And of course, you see that we have this alpha and beta factors. They are in the future price, so they are reflected. Now, the huge question we asked ourselves actually how to estimate this kind of model. So, because traditionally for the Gibson and Schwartz model, it's quite simple. You use the Kalman filter and you have your traditional future data. But now for our model, we also have the inventory data which we have to reflect, right? And we thought about two ways actually how to include them. The first way is in what we call then in the following procedure 1 is where we say, okay, let's include the inventory data, but let's allow in the Kalman filter also for error in the inventories, so that the Kalman filter also will estimate our inventory data, because we will use the inventory data, but there will be another. We will allow for an error in the inventory data, so that the inventory data might not reflect the real world inventory data, but that the real world inventory might have an error to the true inventory state variable of the Kalman filter, what he will estimate. In procedure 2, we will not allow for this error, but we will use the inventory data directly for the Ornstein-Uhlenbeck process, and we'll fit it directly with this inventory data. So these are the measurement and the transition equation for this procedure 1, where we allow for this error term, and you see here that we have the observed inventory data in the real world, and we allow here for an error term, so that the state variable of the inventory might have an error term. And we have here the transition equation. And of course, for procedure 2, this changes a bit because we don't allow anymore for an error term of the inventories, but have it directly here then in the measurement equation. So let's have a look at the data what we used in order to estimate our model. We used crude oil fuel data, used weekly data from NYMEX. We used the data period from 1990 to 2012 with including 1,199 data points. We used the future contracts with 1 month up to 9 months contracts, which is typically, and you will find also that Gibson and Schwartz use those contracts in their papers. So we think that's a good starting point. And then I think the interesting, or for you, the more interesting question is about what kind of inventory level data did we use. We used US weekly crude oil inventory data, which are publicly available from the website of the Energy Information Agency in the US. And we use now all the US crude oil stocks data, excluding all the strategic reserves, because we say the strategic reserves might not be so relevant. And then we also made some transformation of that inventory data series in order to reflect and investigate later non-linearities. So we used the inventory, but also used log inventory and the inverse of inventory series in order to see if non-linearities have an effect, actually, because in the empirical studies of Gordon, Hayashi, Rubenhorst, they have actually shown that this dependency between the convenience yield and the inventory levels is actually not linear, but they have some kind of non-linear feature. And then we split our data set in 3 panels. One panel which we go over the whole time, just for an in-sample, and then we split an in-sample from 1990 to 2004, and an out-of-sample set from 2004 to 2012, so that we can have a look how does the model perform in-sample, but also have a view on how is the performance of the model out of sample, and especially then against the benchmark of Gibson and Schwartz. Now let's go through the empirical results. I will present you results about the parameter estimation and the sharpness, and I will present you estimate results of the in fit and also then about the out of sample fit. So from the parameter estimates, we will realize that our model is able to estimate the parameters of the Gibson-Schwartz a bit sharper. So sharper compared to Gibson-Schwartz. These parameters alpha and beta, which are very relevant for our structural relationship between the convenience yield and the inventory levels, are highly significant, which is very good at the 1% levels. And we also see that the core parameters of the volatility of the spot price process, for example, these are quite comparable to the figures in size of the one in Gibson-Schwartz. So here we see it. We see alpha and beta, which are all significant at the 1% level, which is very good. And then we see also that we have this negative dependency between the inventory levels and the convenience yield, which is also very important because our results are then in line with the empirical work we have seen so far. And we see that, for example, here in the volatility of the spot price process, we are quite similar parameter estimates. So there we have not huge outliers, which are completely different estimated in comparison to Gibson and Schwartz, which makes a lot of sense. Then, of course, we have also reported the log likelihood scores to get a first feeling about how our model performs in sample. And it's not very surprising that the log likelihood scores are a bit weaker than in comparison to the Gibson and Schwartz model, because as you have seen, we have now used the structural relation, which makes, of course, the model not so easy to fit in sample. So it's not surprisingly that the log likelihood scores are not so strong in sample. And here the log likelihood scores are a bit higher. This is due to the fact that we allowed for the error in the inventory terms, but when we adjust the log likelihood scores, I mean, they're also a bit weaker. Then continuing with the in sample performance, we use the log likelihood scores and also calculate then like the typical archaic and base information criteria. They are of course a bit weaker. And when you look at the typical measures with what you look at when you compare asset model performance, like the root mean squared error and the relative root mean squared error, we will see here on this table that we are also a bit weaker with our model, which is of course not so surprising as I told you, because we are not so flexible. But now what is much more interesting is now when we come out of sample, because this is actually what the real people are really interested in, and what is actually most important, how is the model's performance out of sample. And we will see that actually when we look at the hedging error, so what we did is we hedged the 7-month contract with the 5-month and the 1-month contract. So when we calculate the hedge ratios with our model and then look 1 week and 5 weeks in future and see how that hedge portfolio changes in value, we see that the hedging error actually can be reduced by our model, using our model compared to when using the Gibson and Schwartz model. We see that for the 1 week horizon, we can reduce the model, the hedging error around 14.181%. And when we look at the median hedging error, it's around 6%. And we also will see that using nonlinear information inventory data series is also higher in performance, has a better performance. So here's the table which I was referring to. We see here the reduction of mean. We have the Gibson and Schwartz model, how it compares to the other models and how strong the reduction. So we see that the 1 over inventory level data series estimated with the procedure 2 can actually has a 14.81 lower hedging error than the Gibson-Schwartz model, and it's significant at the 1% level, which is very good actually. Yeah? And then here we have also at the lower end reported the results for the median reduction of the hedging error, which is also highly significant. So we see that the procedure 1, where we allow for this error term, is not performing that well, but the procedure 2, where we really use the inventory data without any error, but can use the inventory data to estimate our on-chain process, it's performing very well. And also when you look, the 1 over inventory is definitely more performant, has a better performance than only using log inventory or inventory. So let me conclude our results. So first of all, what we did in our paper, we introduced a new 2-factor model, reduced form model, and this model, in order to use inventory information as a second state variable, this model exhibits superior hedging characteristics out of sample. then from a practical point of view, this model is quite appealing because it allows that you directly can include views on the inventory levels into the pricing. And our results confirm also the already the negative dependency between inventory levels and the convenience yield, which we know already out of other empirical studies and which is in line with literature. So thanks a lot, everybody, for listening to my talk, and I'm happy now to get the comments from Ehud.
Okay, thank you very much. So the discussant for the paper is Ehud Ronn.
Good morning, ladies and gentlemen. It is a distinct pleasure to discuss Sebastian's paper with Marcel. What I'd like to do in my comments today is talk a little bit about the contribution that Sebastian and Marcel have done to the literature in terms of this two-factor model, which Sebastian did a great job of presenting to you. What I'd like to do is to contrast it a little bit with the extant literature, as well as talk a little bit about something we spoke about yesterday, which is the role of what one might call commodity-based multi-factor reduced form models in explaining the oil futures risk premium, which I think is an important issue to which we can all contribute to the literature. But before I begin, I really want to say how much I enjoyed reading this paper. I think they've done a great job, and I'd like to enumerate a little bit where I think they have done such a good job. So as Sebastian indeed presented to you, they have a two-factor model. The two-factor model is the traditional log normal mean reverting spot model, and then you see an affine relationship between the delta, which they put into a normal mean reverting process, and so inventories end up being the second factor, a mean reverting, normal mean reverting process. The first contribution to which I would like to commend the authors is the derivation of a very nice, elegant, closed form expression for the futures contract. I know it's been done in other forms in the literature, but I think it is a commendable and nice way of combining the analytics in a very nice closed form expression, and so I commend them for that. You will notice, by the way, that what I've laid out is the first part of the expression, this part over here, is where inventories come in with their parameters. The second part, the BTT, which Sebastian actually laid out to you explicitly, is what I call the Ito's lemma mean variance correction factor. So I've not laid it out in full, but that's a very nice way that they've done there. They refer to the market price of risk, which they extract, and again, I think this is one of the important contributions we make when we explain risk premiums to our colleagues within and without academia. He did not explicitly address this, but there's a second market price of risk, which is the one for the futures price itself, relative, of course, to the expected spot price. And as Sebastian indeed pointed out, the model outperforms Gibson and Schwartz, another two-factor model, in terms of hedging capabilities. Let me raise a couple of minor empirical questions before I go on to the theory. The Energy Information Administration releases inventory data 5 days after tabulation. So there's a little bit of a time issue between when they collect the data and when they publish it. It's something that one should at least mention or take into account. One of the things that was correctly excluded was the Strategic Petroleum Reserve, which presumably the market does not have access to. But one of the things one might at least mention in passing is that the EIA includes other inventories, such as those en route from Alaska and the Caribbean. And of course, those don't impact, I think, Cushing first order because they're removed from Oklahoma by sea and air and land. And so the reason I point this out is that we know with the disparity between Brent and WTI that geographical location does make a difference. And so perhaps those inventories should be excluded from the inventory tabulation. That might be an interesting way of exploring whether the error that Sebastian and Marcel have found in inventories is mitigated or reduced by that. The other point that I would like to raise is the issue of storage cost. I think everyone appreciates the fact that as inventories fill up, storage costs move up as well. And so you might get a stochastic storage cost effect, and that may or may not impact their calculations. So let me go on and present very briefly the issues that I have in terms of the models that we've seen in the literature. And so as you can see here, basically the literature has derived a set of models that look at 1, 2, and indeed 3 factor models of oil prices to explain or rationalize the term structure of futures prices in a dynamic and consistent way. So one of the nice things, one of the outputs of such models is you get the entire term structures of futures prices presented to you in one consistent manner. So Mike Brennan and Eduardo, going back to the 80s, presented the 1-factor model. Then you see the 2-factor models that we've seen in the literature. And we had a discussion yesterday with Alvaro on some of these, but basically you see Gibson and Schwartz in 1990, Gabillon in 91, Schwartz and Smith in 2000, and Paschke and Prokopchuk, Sebastian's co-author, in 2009. And then there have been a number of 3-factor models. So Eduardo in his presidential address included interest rates. He found it really didn't make much difference. As the 3rd factor, Gaman and Nguyen, and Troll and Schwartz included stochastic volatilities, which did a good job. So there are 3-factor models as well. One of the things that I think we all realize is this mathematical equivalence that you get between all 2-factor models. So Sebastian and Marcel indeed allude to this, that they quote Schwartz and Smith as saying that the model is mathematically equivalent to Gibson and Schwartz. I've heard the term isomorphism used for all these 2-factor models. So there's some sort of equivalence across all 2-factor models in terms of their ability. And I hope no one will be offended if I show my favorite 2-factor model, at least up until now, has been Schwartz and Smith. And what Eduardo and James did there, I think, in a very nice way, is they had these, in fact, Alvaro, I think, presented this yesterday on the whiteboard. They had a 2-factor model in which they had a mean reverting factor and a non-mean reverting factor. And I really like the way this sort of presents itself analytically, in that you see that the futures price here in the first 2 terms has the effect of the mean reverting factor. So chi1 and chi0, you can see how the weights transform between them as t increases. So that's the mean reverting factor. This is the non-mean reverting factor, and this over here is Schwartz and Smith variance covariance correction factor. And so that has a nice interpretation as well, which is that you can see here the effects of the 2 factors in terms of the variance explanation. And so, again, analytically nice, I think, to see the effect of the mean reverting factor, the traditional effect over here. This is, of course, the non-mean reverting factor, just increasing with time. And here you have twice the covariance. So, as I said, this is a model that I've liked using. I've, in fact, tried to calibrate it on a daily basis, which is one of the things you can do to see how you can explain both the cross-section of futures prices as well as the term structure volatility at any point in time. So I will slightly shamelessly conclude with a reference to my upcoming paper, but I think it is relevant. And that is to address what I would at least proffer to you as an alternative explanation to addressing the risk premium. So in all of these 1, 2, and 3 factor models, you explain the risk premium with a sort of a reduced form equation. What I shall attempt to do, with your permission a little bit later, almost immediately now, is to integrate this with a well-known capital asset pricing model, where, as I will show you, as you know, if you do look at the CAPM, you get this relationship over here between expected futures prices, expected spot prices, if you will, and the term structure of futures prices as you observe them today, which is the FI naught over here. So where the risk premium comes from in the CAPM is a product of the correlation between the futures contract and the stock market, the implied volatility of the futures contract itself, and then the stock market Sharpe ratio. And in the context of Marcel's and Sebastian's model, I guess one of the questions that I would like to proffer to you is whether this reduced form model that Sebastian and Marcel have derived is related to the CAPM in the sense of explaining some of these things. So for example, as inventories accumulate, might that be reflected in the implied volatility of the futures contract and exacerbate that as people become more nervous about stocking out, I should say, as inventories deplete? As people become concerned about stocking out, and that enhances and increases the volatility of the futures contract. So let me perhaps conclude with that by saying that this might be an alternative way of viewing the issue of the risk premium in futures markets. And with that, Jerome, I turn it back.
All right, thank you very much, Ehud, for this nice discussion. So Sebastian, any comments or response to Ehud?
Just some comments about the minor empirical questions. So just some comments about the minor empirical questions of Ehud. So the first question was about the data release and the 5 days later. That's actually a very good comment, and we have to look into it. So we have not directly looked at it in our work. The second comment about the oil prices and the geographically thing about the Alaska, Puerto Rico, and Virgin Islands. I think this is also a very, very good comment. We have to think about how available this data is, and if it's possible to really extract it from the data source. But if it is possible, I think then this is of course a absolute next step to check how the model and the performance will change when we exclude it. And the stochastic storage costs might spike as inventory fill up. This is a good question, and we have to think about a bit about how we best to include that, or how we can include that in the model. Because I might guess it's not so trivial, but yeah, let's have a look. But yeah, thanks a lot, Ehud, for the very good comments, and to further improve our paper. Yeah. Thanks. Yeah.
I really appreciate this presentation, and especially for the conduction of the study underlying it. I have a simple question regarding your in-sample, out-of-sample analysis.
Mm-hmm.
So you basically postulate a relationship between the inventory level and the convenience yield. Now, as you write it, the convenience yield is basically the component of the cost of carry stemming from holding the asset that is idiosyncratic to that particular kind of good. Now, as we all know, this component is related to a number of costs and benefits. And it's quite difficult to imagine that all of this component can be reduced to what might be the major of this component, namely the inventory level. So once you have estimated your model, you could try to do an out-of-sample analysis by comparing two quantities. The first quantity is basically the convenience yield you obtain by applying your linearly estimated function to the actual value of the inventory level at a future point in time. And the second quantity is the convenience yield you obtain by computing the discrepancy between spot price and forward prices. Now, if the former is a good estimator of the latter, then your result is quite robust and says, well, let's say that the inventory level is really the determinant, the key quantity expressing this residual quantity. Once you compare spot and forward and you eliminate the purely financial side cost, then what remains is practically explained by that. And that's why I was wondering, why did you do an out-of-sample on hedging as opposed to a true out-of-sample by saying, okay, this is the quantity I have been able to estimate, and this is the quantity that the market gives, and then I compare the two. Is my question clear?
Okay, so we computed the hedging errors because it's a bit nice from a practical point of view, and also quite relevant for practitioners in the market. But I like your proposal about computing also like this kind of real error, out of sample error between the convenience yield. But so I think we just have to apply it and to conduct the analysis, because I mean you're absolutely right that the convenience yield is not to 100% explained by the inventory, but it's like a fraction of I think I've seen something around 30% in some empirical work. So and this was also the kind of idea of the study, really to look and to include it in the asset pricing and to analyze actually if we can actually find out of sample better properties. And yeah, but I like this push to go to make this other out of sample comparison as well. To have a more robust view.
Yes.
All these energy commodities have a strong seasonal component. In fact, a seasonal component that is not explained by the underlying variable. In fact, in the list that Ehud bring is a seasonal component into the modeling. I think that both of your variables, the spot price and the inventory, in fact, if you take your residuals estimation, if you perform a spectral analysis, I think that you will be amazed of what you find, because you will find a really well-defined peaks in certain frequencies, and that means that the seasonal component is there and has a strong weight. So I think that you might consider to do that. I think that it could benefit your modeling, and incorporating the seasonal component will not affect your analytics. You can still come up with a closed form expression. By the way, I should say that Schwarzschild is your best favorite because you haven't read mine yet, but you will. So.
Maybe just to respond to the comment. Thanks a lot for this comment. I think that's a very valuable comment as well. And we thought already about it to include the seasonal component. We decided to do it for the first step not, and this is why we also applied our model on the crude oil market, because there you also, of course, you don't have any harvest, so you don't have this huge seasonal swings within the year. But of course, if one would apply or want to apply this kind of model and thinking for other markets as well, like for
But I think that if you don't use it, it's just a paragraph. If you include a comment saying that in the spectral analysis there's no relevant frequency, because if you perform the spectral analysis in your residuals and you find relevant frequency, it's because there is some weight in that frequency. So if you exclude it, I think it should be clear why you exclude this component. Just
It depends on the data.
yeah, exactly.
If it's oil, maybe it doesn't matter. If it's power or gas, it does.
Yeah, but
And
if
also,
you have
the question of
residuals.
seasonality depends whether it is seasonality on what? On the trend, on the drift, or on the noise term, or both of them. So it might be interesting to include this term either by extracting it from data, and so the model can stay as it is, or alternatively including it into the analytical specification of the model, but then you have to test whether it is significant or not on the market data. Did you apply this to which data? Can you please remind me?
It was on the NYMEX data, future data.
Oil.
Crude oil. Yeah.
So maybe for oil it is not so relevant. I mean, as far as our experience is, they're not seasonal data.
From my experience in oil, what you will find is a long period. So it's not an annual seasonality, but it's a long period that it's relevant. So yeah, it depends on the data, but I think that including an analysis of the time series of residuals could benefit your paper and why you exclude that component.
Yeah.
Yes.
Thank you.
Can you go back to your original 2ST to water? I just wanted to look at that and sort of comment on how I viewed when you presented that. Again, it's this convenient thing, convenience yield, which I'm not too comfortable with. Right?
So here, this slide.
Let me tell you how I would try and tell this story. You show me equation 1, and without telling me what delta is, you say prices will depend on where seasonal or where storage levels are, right? And that's why you have equation 3. So somehow you say, well, if I have too much stored, then prices will sort of be depressed a little bit, or there's a stock up. If I'm below M, I would expect prices to go up, right? So that's pretty much what you're trying to do there. And then your delta, the way you've written equation 2, is to get the units right. So, whatever you have in 1, which is dollars, well, it all makes sense. So my question is, what happens if I is right at M? Okay, what is the intuition that you are where you're supposed to be at that point in time? How would you expect the prices to be drifting in relation to what's happening in the storage side? If the entire market expects them to be at a certain level and inventories are at that level, do you expect upward pressure, downward pressure? Is your model capturing that? That's the kind of a story I cannot see in, with the correlation on your alpha and your beta.
M should be
Huh?
M should be related to the
Yeah, but that is capturing the demand and supply pretty much. Yeah, I agree, but that's, I'm just trying to provoke a little bit of, what you've written there and what delta to me is doing, and whether you can answer, okay, if the market sees that inventories are where they should be, so I equals M, what sort of pressure do I see on prices coming through the inventory level? And why do you see some pressure coming, right? You still have the alpha coming in, right? You still have the beta times I, and I don't see the M there. You see, I'm more comfortable if you had modeled, where you're supposed to be at that point in time and where inventory is. And that tells me a little bit more about where the pressure on the price is trending up or trending down. I don't know, I just saw this and I thought that, if that was the question I would have asked myself when I look at equation 3, how would that affect the drift of the oil?
Yeah, I think it's thank you for the remark. It's indeed a good question. I mean, if this term nets out to 0, I mean, you're left with only the.
You still pressure the drift in 1. Because delta will not be naught.
Yes. Yes.
See, that's the thing I'm worried about in the way that's being modeled right there. But of course, you're right that demand is just kind of the supply side, So to some extent, equation 2 or delta should pick discrepancies from the seasonal storage you expect to be in compared to to where you actually to where you are.
Yeah. I think we just have to think about this comment a bit more in detail, but it's a good view.
We have time for one last question.
Not so much a question, but a comment within this room. There's about half a second echo coming from the speakers, and I just wonder if it's possible to turn the speakers off. So when you talk at the front, these two speakers on top repeat your voice about half a second later.
There's a latency problem here.
Can be turned off.
If you sit here, you don't have to say that.
But I hear your voice twice.
Oh, yeah.
I hear it here. No, I hear
This is
it.
the sweet spot. It's not.
Hi guys.
Very good. Thank you very much.
Thank you a lot.
So let's move on to the next paper in the session, titled Using Equity Index and Commodity Options to Obtain Forward-Looking Betas and Condition CAPM Expected Crude Oil Spot Prices by Ehud, Ronn, Chris Baum, and Paula Zerilli, and Ehud is presenting.
Okay. Well, good morning again, ladies and gentlemen. I'd like to, before I begin, thank Andrea for organizing the session, Jerome for chairing it, and the organizers of the conference for inviting the paper. I'd also like to express my thanks to the British Airways Corporation for hopefully delivering my luggage later today.
My question too.
And others. Permit me to describe a little bit the paper that my co-authors and I have been working on, which I'd like to present to you. So what we're trying to do here is use the conditional CAPM to forecast spot prices. And what we'd like to do eventually, and we're only laying this out initially or the outset here, is to use only forward-looking indicators to forecast this measure. And so essentially what this is a search for is a forward-looking measure of beta. And so I'd like to talk a little bit about where the literature has gone and see what it is we're trying to contribute in terms of the methodology of obtaining a forward-looking betas. As you know, most betas that we use are historical with different moving windows on the past, and we are doing that as well. But that's en route to what will hopefully be a purely forward-looking beta that we'd like to use. En route, I'd like to address something that was raised yesterday in a lot of settings, and that is this issue of what some have termed a financialization of oil markets. And I think that the very terms that we use, the semantics that we use, are indicative of what our priors are on this matter. Because when you use the term financialization, there's a presumption of a pejorative there. There's something bad about these people in New York or London or elsewhere maneuvering and manipulating markets. Notice that if you change that to the term integrated capital markets, now what was heretofore pejorative becomes a benign, in fact, an expected outcome. And so I think that's one of the things I'd like to talk along the way is show some evidence that markets are not just being whipsawed by these folks trading in New York, London, or elsewhere. So in terms of the forward-looking parameters that we'd like to extract, one of the things I'd like to talk about is the issue of a term structure of implied betas for equities. That at least potentially has something to say beyond just energy, and that is the issue of can we extract a term structure of implied betas and what implications that might have for capital budgeting decisions by corporate finance people. And then the issue of calibrating 1 and 2 factor models of the implied correlation term structure for the crude oil futures contract. We'd like to talk about that as well as I present the model to you. Since I have a little bit of time, let me talk about whence the literature has come in terms of at least the issue of implied parameters. So as I laid out, I'd like to present the issue of implied volatility, correlation, and implied betas. That, of course, goes back to the historic paper, I guess historic is the right term, by Latané and Rendelman back in the 70s on implied volatility. There's a number of folks who have looked at implied correlation. Siegel and Margrave have looked at that. And more recently, there's been a number of papers, this is one of the important ones, on looking at option implied volatility and skewness measures. And so CCJV, if I may call them that, have this relationship over here that looks at the skewness and variance in the option markets to extract an implied beta. And so just to recap, the reason the implied beta is important to us here is that we'd like to have an instantaneous forward-looking beta rather than a moving window beta that uses historical prices. There's been a couple of folks who have looked at the CAPM in terms of crude oil futures contracts. So you've got Fouquet et al. On continuous time CAPM and Rita de Clesia and al. On time-varying correlations. A number of people have noticed that these correlations have recently, and by that I mean the last 7, 8 years, have moved from where they were in the earlier period. So I'd like to cite those as well. By way of motivation, ladies and gentlemen, I'd like to present to you the following. And some of these ticker symbols that I'll use are Bloomberg ones, so they're the ones where we extract the data. And so what we're looking at here is the S&P 500 in terms of the equity market representation. And CL1 is the prompt month futures contract for oil, the one that is indeed traded at Cushing, as Sebastian said. So what I'd like to show you here, is no, all right, we'll do it the old-fashioned way. It's all right. It's all right. I'll do it the old-fashioned way. What you see before you here is a moving window correlation between the prompt month contract on crude and the S&P 500. The window itself is of length 45 days, and of course we're looking at rates of return on both of these instruments. And so what you can see is essentially what happened during and in the aftermath of the Great Recession. You had this very strong positive relationship between the prompt month contract of oil prices and the S&P. And essentially, if you remember that period, you had on-risk days and off-risk days. In off-risk days, the sun was shining and everything was glorious, and so both prices moved up as the recovery began. In on-risk days, the apocalypse was here and both of them fell. And so you had this very strong positive correlation over here, which, as I said, a number of people have noticed, until you hit the spring of 2011. And that's when it turned negative. And of course, you can see the sharp change, and it turned negative because what happened in the spring of 2011? Not that long ago. The word spring should be an indication. The Arab Spring. So the point is, I guess I shouldn't wander around. The point is that the market is sensitive to supply side and demand side shocks. So long as the demand side shock was in control, you had this positive correlation. When you had this geopolitical shock that came in, it turned strongly negative as prices rallied and the S&P fell. And just by way of a little bit of historical context, this wasn't so much because of oil coming to us from North Africa. Libya does not produce that much, Egypt even less. They were never big factors. The real concern was
Saudi Arabia.
Contagion to the Persian Gulf. That was the concern that the markets were concerned with. And then when it appeared that there would not be contagion, we went back to the positive correlation. We went back to worrying about whether the recovery was in place. So the point is that markets do show reasonable sensitivity to things they should be sensitive about, which is what is happening there in terms of supply and demand shocks. And so if you apply the CAPM, I know it's a simple single factor model, the point is that what you get is this simple relationship between the expected rate of return, the correlation between the asset and the market, its implied volatility, and some measure of the equity Sharpe ratio. And then if you take this equation 1 then and plug it in, you're going to get this result over here, that the annualized expected futures price change is proportional to the correlation to which I alluded, the implied volatility, and the Sharpe ratio. And that's really the motivator for the work, is to see whether by parallel to the implied volatility here, which is a forward-looking measure, can we get a forward-looking measure of the correlation, which allows us to explain these kinds of things. And the beauty, if we're able to succeed in doing so, is when you get a forward-looking correlation, you will instantaneously be able to see whether the market is concerned about demand-side shocks or supply-side shocks. So that's sort of the motivator for why we're interested in a forward-looking measure. And the other nice thing that, or the implication of the model is, when you have a supply-side shock, to some extent, futures prices are too high. That's what the literature, the lay literature, refers to as a risk premium, right? Prices are elevated because we're concerned about the availability of supply to demand markets. And so you can see that that is the time when you get a positive difference between the futures price and the expected price. In a demand side situation, when the correlation is positive, you should get the other way around, right? You should get that futures prices are below the expected prices as you get the risk premium going in that direction. So I think the importance of at least trying to get a forward-looking correlation is to address this issue of when does the risk premium switch signs. So that's sort of the idea. And what I'd like to do, since with Jerome's permission, I have a little bit more time, I'd like to give you some ex post evidence in support of this notion that the correlation is important in terms of the sign of the expected risk premium. And I'd like to do so in two ways. So what I'm showing you here is the result of a simple regression of the rates of return on the futures contract on the stock market, and then I reiterate the risk premium issue. So the point is that if you divide by the implied volatility, you get something that is proportional to the correlation, indeed the sign and its magnitude. So what I've done here is the following. To address this issue, I divided up the period between October 2007 and July of 2014 into 10 decile ranges in terms of the correlation. So I draw your attention to the fact here that the correlation, this is sort of declining, as you can see. The correlations reached a high of 0.7746 during this period. They were as low as minus 0.5479. I divided the period into these 10 deciles to see what the average value of the scaled intercept, scaled by the implied volatility, was over that period. This is sort of an ex post rate of return. And the point that I infer from this is that as you go to an increasingly negative correlation, that intercept term is increasingly positive, meaning that futures prices have moved up, adjusted for implied volatility, relative to where they began. And so I think this is one of those things that demonstrates, it's not purely monotonic, and I'll admit the statistics haven't been done, so that's good. You have to worry about overlapping observations. So obviously there's some issues here in terms of statistical significance, but at least as a first pass, I submit to you that as the correlation becomes increasingly negative, futures prices have rallied in light of this, above where the stock market has gone over this period. That's what I'm inferring from this. So that's one measure of this issue of the correlation, the sign of the correlation that the more negative is the correlation, the more you've had a run-up in terms of prices. The other way I'd like to show you this is in terms of looking at something that is a measure of expectations, and we could debate whether this is true expectations or not, but essentially what you're able to do on Bloomberg is to extract what they call a consensus expectation measure. And you have the good people who are doing this. I'm not going to vouch that this is the market's expectation. I'm just giving you this as an indication of the difference between the median expectation of prices and the spot price. And you can see that in the situation right now where we're in a positive correlation, expectation of prices are above the spot, or above the futures, sorry, above the futures. And so that's what you would expect in a demand side situation where you expect prices to move up if we get a good outcome in terms of the economy. And this I would like to contrast for you with, and you can imagine what period I took here. The period I took here is obviously the period of the spring of 2011. And so here you'll notice what you're seeing over here. So indeed, prices on futures contracts have built up in light of the geopolitical crisis and way above where the expected price is. So there's some issue about the relevance here, I think, of this correlation. It seems to be related to what is happening in terms of the run-up of prices as well as the expectation of prices going forward. Having done that by way of motivation, let me talk about the model that we like to try to use to extract a forward-looking beta. And so we take the standard regression of trending relationship, the one-factor relationship between rates of return and the market. We apply the variance operator, and you get equation 5, which has the variance of the futures contract of maturity I, its beta, the variance of the market, and the idiosyncratic variance. And this applies both historically as well as in forward-looking data. And the forward-looking data which we'll use, obviously, is that extracted from option prices. And so what we're going to do is, as you can see in 6 and 7, we're going to lay on a structure on the historical beta as well as the historical idiosyncratic variance, and say that what the market prices of the options are telling you is that the forward-looking one is some perturbation, either multiplicative or additive, relative to the historical. And as I'm sure you've seen, one of the things that you can extract from this is a term structure of equity betas, right? Because you have implied volatility of options going out some distance into the future, liquid ones, say 1.5 years out. So that's one of the things that we get as a byproduct of this. The other thing that you get as a byproduct is something what the market is telling you about future idiosyncratic risk, because you can see in the second equation, you can also see what the model is saying about what option prices are saying about future idiosyncratic risk relative to its historical antecedent, which we can observe. There are a number of issues here which my co-authors and I are struggling on and working on. And that is, what is it that separates the historical from the forward-looking ones, if you wish? What is the difference between the P measure and the Q measure? And so one of the issues that we have to address here are the issue of, the information set that the market is using. Obviously, forward-looking, the market is looking at more than just historical returns. And then there's the difference between P and Q. There's the issue of the market price of volatility risk, which we're thinking about addressing explicitly as well. And obviously, there's been a lot of work on this. So these are some of the issues that are theoretical but impact our empirical work, and which we'll struggle to address a little bit better. Let me show you the results with respect to specific stocks. So there are 8 stocks in Bloomberg's Biz Oil P index. This is an index of oil prices, equities. Obviously, there are a number of these, but this is the 8 that we're looking at. These are the well-known names that we're looking at. We're looking at historical returns, obviously. We're looking at the at-the-money implied volatility. So obviously, you know there's a volatility skew. We're not addressing the volatility skew in this paper. We're just looking at the money implied volatilities. And so we're looking at these stocks, looking into the future. So those are the 8 equity stocks. And we're also we're going a little further than we're going 24 months into the future on oil futures contracts because we find implied volatility on these extending out 2 years. There may be an issue of how liquid they are, but at any rate, since we have them, that's how far out we're going in terms of the oil futures contract. And of course, we're using the S&P as the equity market. So with respect to the term structure of equity betas, what I'd like to say here is that you can see that what I've repeated in equation 8 is this relationship between the idiosyncratic variance, beta squared, the market implied volatility, and the idiosyncratic variance. And you can see that if you have a term structure of such implied volatilities, you can sort of link them. And the way we've linked them is in equation 9. So what we're saying is that for each stock, its beta with respect to the market across different maturities is its historical one. So this is whatever the history is, plus an additive and linear factor. We've looked at quadratic as well. So basically what you're doing here is you're linking these options across the different maturities by imposing a structure of how the forward-looking betas relate to the historical ones through this structure that you see here in 9, namely an additive component and a linear correction. And as you might imagine, we simply solve for the minimum residual variance, if you will, on the difference between the left-hand side and the right-hand side of 8. In other words, what are the coefficients alpha that would best explain the term structure of implied volatilities and options that we observe through the inputs into equation 8, the idiosyncratic, the market, and the systematic, or the stock specific, I should say. So let me show you what we get on the linear component on these equity betas. So one has to be a little bit careful in interpreting this because, as I'm sure you realize, the weighted sum of all betas across all stocks has to be equal to 1. That's not going to change for any maturity. But for specific stocks, you can see that if they are sensitive to the economy, their betas might be increasing relative to historical as you come out of the Great Recession and as the correlation, as you saw, turned strongly positive. So that's one inference one can take from this graph. Let me show you what I found interesting with respect to the idiosyncratic variance. And this sort of tells you whether the forward-looking variance on average is smaller. I would submit to you that what you're seeing here is what we should expect when we enter a recession. So as you know, when we enter a recession, correlations tighten and idiosyncratic variance reduces. And so this is sort of what I infer from that, is that what the market's saying looking forward is, look, if we're entering this recession, things are going to move more in tandem. You're going to get a stronger correlation. You're going to get less of idiosyncratic variance. So perhaps some indication of the informational content of what we're doing here. So that's with respect to those 8 equity options, 8 stocks equity options. With respect to the crude oil model, what we're looking at is what I've shown you here, except now, of course, we're looking at different maturities of crude oil futures contract. Again, equation 11 applies. The correction factors here are very similar to what you've seen on the equity side. So namely, what we do is we take the historical, we link the different maturities through an additive and then linear and quadratic correction factor that allows us to link these options across their 24 maturities. We do it additively and multiplicatively. So that's sort of equations 12 and 13 allow us to link these, pooling them together across these 2 years maturity. And here I only have initial results to report. You see there's a lot of noise in these things, so we're trying to really force the data to tell us a lot. I think that there's some lead information here in that the additive correction here does seem to lead the historical as we enter into 2011. So what I'm saying here is that the implied beta is moving before the historical one does, and that hopefully will be able to give us a better sense of what to do about this implied beta, which is what we want to do to see the instantaneous beta that the market is forecasting at any point in time. So clearly there's more to be done, but this is sort of an initial indication that perhaps we can anticipate some hopefully positive results out of this. So to conclude my portion here, what we've attempted to do, as I said, is to combine historical implied volatilities. We've done so both for equity betas in the oil industry, those 8 company stocks, as well as futures contracts. We think it's important to focus on the sign changes in the correlation as the market switches from concern about demand side issues to supply side issues. We're seeking to get forward-looking correlations so that we can indeed come up with the forecasted P measure of expected crude oil prices. And I think there's some support to at least looking at the CAPM in this context. My last comment, if I might, is just to say that there's another 2-factor model that we can look at. And notice what I've done here is I've decomposed the equity returns into, or projected them onto the market and on crude prices. And the reason why that may be advantageous is if you take the variance operator and apply it to the first equation, you get the second equation. And what appears in the second equation is the correlation between the stock market and crude oil. So there may be another way for us to look at this, which is a 2-factor model, and we can tease out or extract this correlation between oil futures and the S&P, and of course contrast it with what we get from our 1-factor model. So with that, Jerome, I return it to you.
Okay, thank you very much, Ehud. So Rashid Brick is going to comment on the paper.
Thank you very much. Sorry, today Professor Ben will not be here, so for some technical reasons, I will replace him. For this reason, I will make a simple discussion about his Professor on paper, since I couldn't have a chance to read your paper. So I will try to contribute myself to your paper. So to summarize about your paper, it's a really nice paper, because the thing is you have a link, you make a bridge between 2 fields, capital asset pricing theory and the energy market in this paper. In the last year, you have more and more paper about this, but you have to know that the energy market are really important in the economy for the geopolitical reason. When you have a change on the price of oil or the gold, you have an impact on the equity market and other markets. So that is a very nice study, especially with what happened in the last years. So it's a really nice paper for this reason. Another reason that you have made a very high contribution about your equation, which link the expected of the future prices and the term structure of the term structure using only correlation and the implied quality, which through the market price of risk, which is really nice, and it's easy to interpret the risk when you see, for example, what happened with the revolution in 2011 with this simple equation. So my question is, do you think it's possible to extend your work using some vector auto regressive models? Because the thing you have, as you know, the oil market, you have some high correlation to 20 days, something like this. So maybe it's better to have a fine model to explain some and to have less noises, and also to make a trend which is followed by this autocorrelation property. So that was my only question.
Very good. Thank you very much, Rashid. Would you like to respond to this comment?
Yes, thank you, Jerome, and thank you, Rashid, for stepping in. I know this was a last-minute thing. Should I thank Rashid again? Or... Anyway, thank you, Rashid, for stepping in. I know this was a last-minute thing, so I commend you on doing that. I appreciate that. The other factor that we've looked at is indeed stochastic volatility. So you can see that that's something with which we might be concerned, and we're sort of thinking of integrating that explicitly, since, as we said earlier, I think that might be an important one in terms of explaining the issue of the p-measure expected value relative to the futures contract. The last thing I would like to say in response, the issue of emerging market is obviously one that's been very important the last couple of years. At this point in time, Rashid, I think what we're going to do is stick with the S&P as reflecting that in itself. So I think it's fair to say, at least anecdotally, the S&P is indeed sensitive to what's happening, in particular to the Far East, and so we're assuming that that's going to be reflected in that. But your issue on the second factor is a very well taken one.
Other questions or comments from the audience? I have a question actually about the coefficients relating the historical and prospective betas and sigma. So these are basically stochastic processes, yeah, right? I mean, so the alpha and the A and so on. Is there any structure that we can extract from the empirical results that you obtained?
That's a very good point, Jerome. I think that one of the trade-offs that we have to make, as I think implicitly is in your comment, is whether to fix these over some time period. At least that's one of the trade-offs. Fix it over some time period and extract the constant one. What we're doing here is a little bit of a concession to what real-world people do, and that is a daily recalibration. And I realize daily recalibrations are subject to intertemporal consistency issues. I think the appeal of a daily recalibration to us is that you get a snapshot each day of what the market is thinking about the future. And so that is indeed a trade-off that we have to make. As I said, one of the things we are looking at is sort of a model in which stochastic volatility. But your points, I'll take.
Great. Other questions or comments?
This is, I really like this approach of forward-looking betas, right? And I thought about it years ago, and I didn't even know how to start. So I appreciate this, your contribution. So what are these papers doing in the equity? They're on the, so for equities, right? Yes. How difficult is it, or what is easier? If I had to compare the approaches, where are the wrinkles in, let's say, commodities or energy, as opposed to equity, where you have more liquidity, you have options as well?
Okay, so let me start on the last one, Alvaro. We're not dealing with the liquidity issue per se. We're assuming that what we observe is what we have, and so your point there is well taken. What Chang, Christofferson, Jacobs, and Weinberg have done is they've done a forward-looking beta on equities, looking at, as you can see, the volatility skew. So their inferences from there, we're sort of looking at historical and then seeing what perturbations we should apply to it. But that's a good paper, and I commend you to look at that and see if you like that approach as well.
Very good. Thank you very much. So this basically concludes the session on energy. I would like to thank all the speakers, discussants, as well as the audience for their questions.